Right, it's Jonathan again on the BDO panel. We are live and good to go. Thanks to everyone who's been waiting on the line. We are ready to kick off 12:30 start here. We've got an hour scheduled for the briefing. We may be a little bit shorter than that given the content from yesterday's statement, but we'll work our way through. We'll have some time for questions and answers, and then we'll see where we get to there. So please bear with us as we progress. As I say, welcome to our autumn statement webinar. I'm Jonathan Hickman, I'm a tax partner here at BDO. I lead the firm's budget cycle reporting, and I'm joined today by Howard Beers, who's a director in BDO's Corporate International Tax Services, by Michael Ashdown, a director in our Indirect Taxes team, and by Ross Mackay, a director in BDO's Private Client Services team. As is always the case with these things, before we begin, I'd just like to highlight some of the features of the event today, just to give you some rules and regulations. All attendees who are on the line today on this webinar are in a listen-only mode, which only requires the speakers in your PC. So please ensure that you join in the conference, that your audio volume is turned up so that you can hear us. If you're not using the PC and would rather use teleconferencing details, they're available for anyone around, or if you experience any difficulty with the audio broadcast, but you'll clearly need a telephone line to be able to do this. If you have any content-related questions, you can submit them at any time using the Q&A/chat functions, which are displayed, I'm told, in the bottom right-hand corner of your WebEx console. If time permits, and I suspect it will, we'll have a Q&A session at the end of the webinar. So please submit your questions at any time during the presentation to all panelists, and we'll respond verbally to those questions. Or after the webinar, we might well need to come back to you by email. It just depends on the level of questions that we get at the time we've got at the end. In any case, we're going to be sharing the slides from today's presentation after the webinar, and they'll be emailed to you along with a link to a recording of today's broadcast. In case you missed anything because we progressed through or stuff wasn't clear, you can always go back and revisit it, and if you've still got questions, then you can obviously contact us on the panel at any time. Right, so let's get started. We're broadly running through the agenda that you've just seen. But we're going to try and focus a little bit more on what it really means for business and individuals, what the Chancellor said and what it actually means in reality. I'll make no excuses, but a lot of the technical details were held back yesterday and won't be released until Finance Bill, which we expect at the beginning of December. So that either shows that they're in a rush to get things over the line in time, or they're actually just starting to coordinate things a little bit better. We know that this was Mr. Hammond's first and last autumn statement, so his plans to move to an autumn budget are already in progress. So what do we know? Well, we know that the Chancellor had a really difficult balancing act. He's got a relatively positive economic environment on the one hand, but he keeps on telling us that the expected uncertainties caused by Brexit are just around the corner on the other. He certainly made a big thing of the fact that growth has been suppressed by the fact that we have to enter into these Brexit negotiations, that the economy will no doubt suffer as a result of that, and he has to work out the balance to drive us through that. Anyone who listens to the Prime Minister's questions before the statement will know that Mrs. May was quite vocal and persistent in telling us that the government is committed to triggering Article 50 before the end of March next year. So the question left for Mr. Hammond was, what could he do to help the economy steer its way through this? We think generally he presented something that was well-balanced and user-friendly and was in the main positive for business. But I think you probably could say that it was mainly positive because it wasn't negative, if indeed you can actually say that. But there were no big surprises that we went through. So we don't have a concern of last-minute tax adjustments that would upset the balance. So, some growth rates. As I say, Mr. Hammond was clear that the Brexit vote has definitely had a suppressive effect on the growth, and as a result, he's now abandoned his commitment to a surplus by 2020. He's been able to borrow in the short term, so he's made some extra borrowings with a commitment to the longer-term investment in both infrastructure and innovation. That's really aimed at reducing the productivity gap, something that he focused on that the UK was clearly lagging behind certain competitors, and he seemed particularly concerned that we lagged behind Italy when he talked yesterday. So clearly that's the one he's got in his sights to overtake as a result of this. As I mentioned, he also avoided any surprise tax announcements. I mean, a bit like the stock markets, we in the tax world don't like anything that's sprung upon us that we need to get our heads around, that we need time to plan for. So we all know that taxes are going to increase. We can see them coming around the corner. Well, a lot of these announcements were just reiterating announcements that had previously been made in the earlier budget in the year. You also managed to get a laugh or two along the way, which is always positive news from a Chancellor's perspective, and does seem to be something that's on their challenge as they go through. So we're now going to take you through the detail of the main changes as announced, and I'm firstly going to hand you over to Howard, who's going to cover corporate and business taxes.
Thank you, John. Excuse me, my name's Howard Veers, and I'm a director in our Corporate International Tax Group in London. Well, let's start with looking at corporation tax rate. So in March this year, the government published its business tax roadmap, setting out a series of planned reductions in the corporation tax rate from 20% this year to 17% in 2020. Now, there had been speculation that the 17% rate would reduce further to 15% in 2020, specifically to match Donald Trump's election pledge to reduce US tax rates from 35% to 15%. But in the event, no such announcement was made, and instead the Chancellor said that the government would recommit to the tax reductions and the other measures as set out in the business tax roadmap. So we're going to look at the proposed changes to limit corporate tax deductions on interest expenses and the use of brought forward losses, both of which have been subject to recent consultations. Regarding innovation, the Chancellor announced a number of spending pledges to promote R&D and productivity, and an intention to build on the R&D above the tax credit regime that currently exists. Also included was an announcement on a consultation to bring non-resident companies' UK income into the charge to corporation tax, and there were further reforms to business rates and an announcement on the substantial shareholder exemption relief consultation. So this slide summarises the corporate tax rates for the current year compared to next year. And the key point to note here is that the rate of corporation tax will, as we know, reduce to 19% from the 1st of April 2017. And as I've already mentioned, it will reduce to 17% with effect from the 1st of April 2020. Now, one of the most significant changes in the business tax roadmap is the planned introduction of an interest limitation rule from next April. Now, this is part of the OECD's Base Erosion and Profit Shifting Project, specifically Action Point 4, which sets out best practice for tax treatment of interest expenses. And from next April, relief will be limited to 30% of UK EBITDA, which is supplemented by a group interest override. And this measure is expected to raise approximately £1 billion of revenue for the government and will particularly affect UK groups which have borrowed to finance overseas operations. Now, some had hoped that the measure might be watered down or even deferred in the autumn statement, but to the contrary, the Chancellor explicitly stated that this measure would be implemented next year to address what he described as the pitch being tilted in favour of large multinational groups. Now, we're expecting draft legislation on this on the 5th of December, at the beginning of December, as John said, and we're specifically working with a number of groups to help them understand the impact it will have on their tax profile, which could be significant, and the ways in which they can refinance their UK debt. So my next two slides contain a very high-level example of how we expect the interest limitation rule will work in practice. Now, in my example, the UK subsidiary is part of an overseas group. The UK subsidiary has interest expense of £5 million. You can see that on the right-hand side, and has UK EBITDA of £15 million. Now, the overall group expense is £7.25 million. See that on the top right-hand side. And there's total EBITDA within the group of 23 million. That's the 8 million on the left-hand side and the 15 million on the right-hand side. So applying the fixed 30% EBITDA ratio, the UK company will have an interest limitation of £500,000. You can see that in Section A. Now, the group ratio, which can actually come to the aid of companies to possibly reduce the disallowance, in this case, in calculation B, it does reduce the restriction, but there is still a restriction here of £250,000. Now, also included in the business tax roadmap and recommitted to by the Chancellor in the autumn statement is reform of brought forward losses. There are two elements to the reform. The first is a more flexible use of brought forward losses to enable a company to offset them against other types of income, either within the company itself or by other group companies. And this will apply to losses arising on or after the 1st of April 2017, covering trading losses, non-trading loan relationships, losses on property trading, property business, management expenses, and non-trading losses on intangible fixed assets. And alongside this welcome reform is a proposal to restrict the amount of taxable profits that can be offset by brought forward losses. And for profits over £5 million, there will be a 50% restriction on the amount of losses that can be offset. And this will ensure that profitable companies pay tax on at least part of the profits generated in the year and cannot be sheltered, they cannot shelter them entirely with brought forward losses. Now, the autumn statement specifically contained a comment that the government wishes to simplify the administration of the new rules. And it will be interesting to see whether since the consultation there's been any movement away from the scheduler system of taxation that we have in the UK and the need to generally stream trading and non-trading losses and profits. Now, Budget 2016 contained a significant business rates reduction package, mainly benefiting small businesses, which the government calculated was part of a package worth, incredibly, £6.7 billion over the next 5 years. Now, some had hoped that the autumn statement would contain additional reliefs for those areas likely to be disadvantaged by the next business rate revaluation, which will take place in 2017. But instead, the autumn statement only contained announcements that the rate of rural business rate relief will be increased to 100% to match the small rate of business rate relief that was amended in the budget from the 1st of April 2017. Now, something not previously announced was that the government will enter into a consultation in Budget 2017 on the introduction of new rules in the way that non-resident companies are taxed on their UK income. Now, currently companies which trade in the UK but do not have a UK permanent establishment are subject to income tax rather than corporation tax. And there are differences between the two sets of rules which are likely to get more significant in the future. The first is, as we've been talking about before, the rate. So the rate of corporation tax is reducing to 17%, but the rate of income tax will remain at 20%. And there are also differences in the way the rules apply to corporation tax and to income tax. And specifically, to pick up what we've been talking about so far, the new interest limitation rule and the changes to brought forward losses, these rules will only apply to corporation tax and not to income tax. And although there are some benefits from bringing such companies within the charge to corporation tax, any change is likely to adversely impact non-UK resident owners of UK investment properties, which are often highly geared. Further, companies within the charge to corporation tax are taxed on both income and capital gains, and non-resident companies are generally not charged to UK tax on capital gains, other than those arising on residential property. So extending the charge could result in capital gains not previously within the charge to UK tax becoming chargeable in the UK for the first time. So just to wrap up on some other business changes that were included in the autumn statement, I previously just touched on the announcement that R&D above the tax credits may well be, I think the word was built on the above the line tax credit. There was no further details on that. Following the consultation on SSE, the government wishes to simplify the rules. There were no real substantive changes contained within the autumn statement on that. We saw an announced change to the anti-hybrid rules affecting the deduction of interest again, but we'll have to wait until the 5th of December on that point. And also we saw there was a small change to patent box rules, more in the mechanics of how it works in various cost-sharing arrangements. Thank you.
Thank you very much, Howard. That was some really interesting stuff in there. As I say, a lot of the changes that are not new announcements, but clearly we know now they're going to become law. I think the point around interest deductibility and loss utilisation certainly means that a lot of groups and companies are going to need to start planning for cash tax payments perhaps earlier than they were previously. So something, again, that we're working a lot with our clients on just to help them through that process. If we can turn now to hand over to Ross, who's going to cover our personal and employment taxes.
Thank you, Jonathan. My name's Ross McKay. I'm a Associate Director in our private client team here in London, and I'm going to be running through the private client announcements and also a brief overview of some employment tax announcements as well. So, as Jonathan said from the very start, we didn't get any real surprises in the autumn statement in terms of personal tax. We normally have one or two, but we didn't really have too much by way of surprise. So we've got up here that just confirming the personal allowance will go up to $11,500 from next tax year. We expected it to go up to around that, and it's part of the government's commitment to get that up to $12,500 by 2020. The basic rate threshold also went up. Again, pretty much expected that those two would go up. So for tax year 17-18, essentially an individual can have up to £45,000 of income, and they won't get into the higher rate of taxation. And that is all part of the government's aim to, by the end of the Parliament, by 2020, that no one earning under £50,000 will pay higher rate tax. The dividend rates, having only recently changed, remain unchanged. First 5,000 tax-free, and you can see the rates applying there on the screen. Capital gains tax, again, we had a bit of a surprise, caught a few people off guard, the announcement in the budget, 2016 budget, so we weren't really expecting any changes there, and all the rates remain as they are. What we don't have up there is the rate that applies to entrepreneurs' relief gains and also investors and new investors' relief gains, and that's 10%. And the annual exemption is remaining as it is, $11,100 for next year, same as it is in the current year. So just to set all those out on a table so you can see pretty much everything staying the same really, other than the top line with the personal allowance going up and the basic rate band going up to $33,500. Other than that, we're pretty much as we are. The additional rate kicks in at $150,000 as it did before. Just a summary there of other allowances. Pretty much, again, we've not really seen much change here. Obviously, the top one is quite a jump up with the ISA allowance to $20,000. I'll come on to that a bit more on the next slide. Pretty much all the other standards they are. But the EIS, SEIS, VCT, no changes there. No changes announced in any shape or form there. The pensions annual allowance remains as it is, and the IHT nil rate band still at 325 as it is currently. So just moving on to the ISAs, there were not really any actual announcements about ISAs other than the £20,000 allowance, and this becomes a really useful allowance now at this amount. It covers all ISAs. At last count, I think there's probably 7 different types of ISAs now that individuals can invest into. Just to highlight one, again, no announcements on this, but it does come into effect next year. So from 6th of April next year is the new LISA, so the lifetime ISA. And that's effectively been labelled as a pension ISA because you can put up to £4,000 into that and get 25% relief on that, taking it up to 5,000, which would be the same as if you put it in a pension. Just a reminder, a lot of people may already know this from the budget, but just a reminder that it does lock in the investment into a LISA account until the age of 55, or if you take it out to buy your first home. And also, you can only do these if you're lucky enough to be under 40 as at the 5th of April next year. But very small increase in the junior ISA limit, but it's gone to a bit of an odd number, but that's just as it's just being increased by inflation, as they previously announced. We have a new NS&I bond, so we've not had one of those in a few years, but that comes in from April next year. But the Chancellor was unable to give an exact rate, but he said it would be around 2.2%, and it depends on market conditions at the time when it comes in. But looking around broadly this morning, before we came onto the webinar, the best rate you could get on a 3-year fixed bond is probably only about 1.6%, so it does look like quite a good rate, and of course it would be tax-free. It is a 3-year bond, so the only downside is you can only put 3,000 in, so a bit of relief for savers there, not a huge amount, but with the ISA allowance and this new NS&I bond combined, it is a bit of relief for savers out there. Non-UK domicile, so there wasn't any specific announcements or anything we didn't know announced yesterday, but so it's more of a reminder that these changes are going to come in from 6th of April 17, and they are substantial changes to the taxation of non-doms. But so the headline change really is that from 6th of April 17, if a non-dom's been resident for 15 years out of the last 20 years, that they're going to be deemed on for all taxes. So essentially what that means is they'll be subject to tax on their worldwide income and gains, whether they bring them here or whether they don't. There'll be no option to pay the remittance basis charge as there is now to get out of that. But there'll also be a rule for UK-born non-doms, so these are individuals born in the UK that had a domicile in the UK when they were born here, moved away. When they come back, they're going to resurrect that domicile for tax purposes. Slightly unfair, a lot of people think, because you may have someone who was literally here for a couple of years when they were born and has never been back, but if they return when they're 50, they're essentially going to be treated as domiciled from the minute they step off the plane. A couple of reliefs there possible under these changes. So we have a rebased election that will apply for those becoming deemed on the 6th of April 17, and also a grace period whereby non-doms will be able to unravel their offshore account. So this is where a non-dom, if they've got a mixed account containing income, capital gains, but clean capital, they may, if they can identify, be able to get that clean capital into a separate account, and then they can bring that tax-free to the UK in later years. But you know, this is a very big change. We're already talking, we have been for some months now, to our non-dom clients, and you know, any non-doms really need to look at these rules and to take advice around this. So you know, we're happy to assist with that if needed. But a couple of other changes around the non-dom area. So these are more in relation to trust. So non-doms have historically used trust as part of IHT mitigation. But so these trusts will also be brought into the into this changes that come in from 6th of April 17. In particular, trusts and companies underneath holding UK residential property will be affected because at present those can be protected from UK IHT, but from 6th of April 17, all UK residential property, no matter who it is held by, whether it's for a corporate or for a trust, will be brought into the IHT net. That not only means there's going to be IHT when the individual dies, there could also be periodic charges every 10 years on the trust that is holding that property. So certainly any UK non-doms that need to be looking at this, particularly UK non-doms with trusts and offshore structures, really need to be looking at this now. A few other, less well-publicised announcements on the private client side. We have social investment tax relief. Not a very well-heard-of relief, to be honest. It came in a few years ago. It operates similar to EIS relief in that it gives the investor a 30% tax reducer. Probably may have not been too popularly used because it had quite a low limit. So it was only previously $250,000 that the social enterprise could raise over a 3-year period. So that's been increased drastically to $1.5 million. So this is a relief that can be used by charities, also social enterprises. So social enterprises, to give you an example, is something like Jamie Oliver's 15 restaurant was a social enterprise, as is the Eden project as well. But so, as we say, we've not really seen this being used greatly. So hopefully, this increase a little bit will, we'll see a lot more investors looking at this as an option for investment. A couple of changes on the life insurance policy gains. I'll just concentrate on the third one down there. So this is the Lobler case. So this was a case of essentially a gentleman who who surrendered his life policy, and by inadvertently ticking the wrong box on the form, and perhaps because he didn't take advice, he ended up with a 700% tax charge. He did, in the end, go through the courts, but whilst there was probably no actual reason in the legislation to reverse this charge, I think they probably felt a bit sorry for him at the end. And the government has essentially now legislated that. So from next year, there's legislation there that will protect people who inadvertently tick the wrong box on that in relation to life insurance policy gains, and that can be reversed. Pensions, not too much. We normally have a lot of changes in pensions over the last few budgets and autumn statements. We were expecting a big change last budget, which at the last minute didn't happen. So we were kind of expecting something this in the autumn statement, but there's not really much. There's only a few anti-avoidance provisions, and those particularly are relating to around foreign pensions and the migration of UK pensions overseas. And just one reminder, just on interest relief restriction, that there was no further announcements along rental property taxation in the autumn statement, but just a reminder that the interest relief restriction does kick in from next April. So, right, on to employment taxes. So we're just going to briefly go over the employment tax changes. The major change, and this has been, we're watching the news this morning, this has been one that's been on there, is the salary sacrifice, and this will be removed from April 17. So salary sacrifice essentially is, as it sounds, people sacrifice their salaries, so employers will set aside a certain amount of an employee's salary, and so you can buy with that what benefits you like. But that's versus sort of the more traditional model, if you like, whereby benefits would just be provided to employees out of their post-tax salary. There were NI savings on salary sacrifice, both for the employer and also for the employee. But from April 17, this is going to be removed, so essentially any benefits provided under this will just get the same treatment as if they're provided out of the post-tax salary. But there's certain protected arrangements, so they're going to relate to pensions, childcare, cycle to work schemes, and also the ultra-low emissions cars. So they'll be protected going forward, as it can still benefit from these arrangements. Also, arrangements already in place are going to be protected for a year, so a lot of employees will probably already made their selections of what salary they're going to sacrifice, what benefits they're going to have. They're going to be protected for a year. If it's a car, accommodation or school fee arrangements, they'll be protected up to 2021 as long as they're taken out before April next year. So we may see a rush of people getting cars through their employer schemes. And just touching there on the new ultra-low emissions car, so with that's one that's a car below 75 grams per kilometre in CO2. So we've seen this limit come down over the years, so I think we'll probably see a few more cars, a few more models coming out that meet these limits. The other main change was the abolition of the employer shareholder status. So this is a very short-lived share scheme, if you like, that was it was introduced in 2013. It grabbed a few headlines at the time, and it was employees giving up their employment rights in return for shares. And it was giving up certain, but not all their employment rights. I think one of the particular rights was the rights to redundancy pay and unfair dismissal as well. So there was quite a payoff there. And for giving up those rights, they could be awarded shares in the employer company. There was a minimum limit of £2,000 of those shares and no upper limit. But those shares would be receive beneficial income tax, capital gains tax treatment. And from 1st of December 16, that is gone. The government, I think, concluded, and I think, our view as well is it wasn't really being used that greatly. They had reduced the limits also at the previous budget, so it wasn't really being used, and it perhaps wasn't being used by the group of employees that the government wanted to use it, and therefore, rather than trying to tweak it, they decided to get rid of it. So That goes, if there's anyone who has these and they had them before autumn statement day, then they'll continue to benefit from the tax reliefs. Just a few other minor employment tax announcements. So we have the alignment of the NIC threshold. This is really the government going, starting on the journey to align tax and NI. NIC on termination payments, so this is just a confirmation, as we already knew, that from 6th of April 17, NIC will apply it on termination payments above the £30,000 exemption. A few other announcements, more simplification ones around PAYE settlement agreements, and also some clarification about on making good benefits in kind. And then we also have increases in the living and minimum wage that come in from 6th of April 17. So the living wage will be going up to £7.50. But the Chancellor does have some way to go, because there is a commitment to get that to £9 by the end of the Parliament. So I think that's everything covering the personal employment taxes.
Ross, thank you very much. So there's plenty of detail there, and as I say, most of it's not new, but there are definitely some things that have come out of that people need to be aware of. I suspect that the teams, people in your teams that are dealing with salary sacrifice and perhaps certainly the non-domicile rules, will find that their phones are ringing quite a lot over the next few months. But of course, we will always encourage people to get in touch, that they can always do a bit more for that. But there's some significant changes and some planning opportunities that are available, so people don't really want to miss those at all. So I'm going to hand over now to Michael, who's going to take us through some VAT and indirect tax changes.
Thank you, Jonathan. My name is Michael Ashdown. I am a director in the indirect taxes practice based in London. We had no major changes to the VAT regime, in that there was no change to the rate of VAT or to any of the thresholds that exist for VAT. However, there were a number of VAT and other indirect tax changes, which I would just like to quickly run through. The first thing is in connection with a new VAT disclosure regime. HMRC has been consulting about this for a few months and has now decided that there will be a new disclosure regime which will come into effect from the 1st of September 2017. This will replace the current regime of having listed and hallmark schemes for VAT, and will align the VAT scheme more directly with the direct tax DOTAS scheme. One of the big changes, though, with the new proposals for the VAT scheme is that the disclosure responsibility will be removed from the user, where it currently sits, to the promoter of any scheme. So going forward, it will be the promoter and not the user of any scheme that will need to disclose the use of a scheme to HMRC. Also, currently, you only have to disclose your scheme if a VAT advantage is one of the purposes of the scheme. Going forward, disclosure will be required if there is any form of VAT benefit obtained, even if that is not the main purpose. This is likely to mean that many more schemes and structures will be caught and will need to be disclosed to HMRC, especially as at the moment HMRC are saying that there will be no threshold below which disclosures will not apply. Failure to disclose under the new scheme will result in penalties that are likely to start at £600 a day for a promoter and could possibly go up to £1,000 a day. HMRC has also announced that they plan to extend the disclosure regime to other indirect taxes, including insurance premium tax, customs duties and air passenger duties. Separately, we are also expecting legislation on enablers of tax avoidance arrangements, and also for penalties for people who participate in VAT fraud, mainly aimed at people involved in missing trader, MTIC-type fraud situations. HMRC has now announced they will be consulting on the rules on VAT grouping. VAT grouping is a situation which allows a number of corporate entities to form a group, and any charges between those entities within a VAT group are not liable to VAT. Currently, only corporate entities are able to join a VAT group, so that is generally just companies and LLPs. So partnerships and sole traders are not able to join. However, following the decision of the Court of Justice of the European Union in the case of Laurentia and Minerva, the UK will be compelled to relax our existing rules, and that is one of the things that HMRC is consulting on at the moment. Hopefully, the proposals will allow general partnerships, sole traders, and most other entities to join a VAT group. HMRC is also looking at the rules which allow for VAT grouping. Currently, the UK allows VAT grouping if all the parties meet a common control test based upon a company law definition. Going forward, groups will only be allowed if there are close economic, financial, and organisational links between the members, and this is based upon the definitions in the Principal VAT Directive. It means the current VAT groups will need to review their operations to see if they will still meet the definition of being eligible for VAT groups, and that is something which we will be helping our clients with going forward. One of the big changes which was announced, and you will have seen a lot in the press about this morning, and of which we have already been speaking to a number of clients, is changes to the VAT flat rate scheme. This will affect a number of smaller and medium-sized businesses. The flat rate scheme is a special scheme which allows businesses below a specified turnover to pay their VAT based on a percentage, by applying a percentage to their turnover, and not to have to base their VAT payable on sales invoices issued or purchase invoices received. These percentages range generally from about 3 to 12%. HMRC is concerned that a number of businesses have been joining the scheme and obtaining an advantage by being able to pay less VAT than they would normally be paid. And this is because these businesses do not purchase many items of goods which they would be used in the business. As a result, HMRC will have a new percentage of 16.5%, which will apply to any business eligible to use the scheme if it has a low level of purchases. And these are purchases of goods which amount to less than 2% of their total turnover in the period. If you fall into these conditions, from April 2017, you will have to use the new percentage of 16.5%, which will generally result in more VAT payable. HMRC has already put in place anti-forestalling measures to stop people prepaying. Going forward, this will mean that many people who are currently using the scheme will need to review their operation of the scheme. And going forward, some people may find it may be more beneficial to move back to the normal method of VAT accounting, especially if they have any sort of residential property included within their business on which, under the flat rate scheme, they are currently paying VAT. One of the big announcements, though, was, I said there was no increase in the rate of VAT. There was, however, an increase in the rate of insurance premium tax. The rate of insurance premium tax has been increased by 2% from 10% to 12%. And this is the third increase in the rate in the last 2 years. Insurance premium tax is paid by anybody who takes out a general insurance, whether that is home insurance, content insurance, motor insurance, or many forms of business insurance. And unlike VAT, it is non-recoverable, so it is an absolute hit to the business and therefore raises a direct revenue for the government. This is why it has gone up 3 times, and this is why we have the third increase this time. We think, as I said, it will affect all businesses, and it's likely that HMRC and the government may look to increase it further in the coming months. There were a few other indirect tax announcements. HMRC has been given an increased power to inspect goods which have been imported or which are destined for export. Currently, HMRC is only able to inspect these goods at authorised premises, generally at a port or at an airport, and this will extend their power to inspect such goods anywhere in the UK. HMRC has been consulted about a registration scheme for fulfilment houses, and they have announced that this will start with registrations from the 1st of April 2018. This is part of HMRC's ongoing policy of ensuring that VAT is paid on all goods which are sold in the UK, even if they are sold by a non-UK business. And the joint and several liability which is introduced for online platforms is part of this. So from the 1st of April 2018, there will be a registration scheme for fulfilment houses. The final thing which was announced is that when the finance bill is published next month, the draft legislation for the new soft drinks industry levy will be published, and hopefully we will find out the various rates that will apply to the manufacture of soft drinks from that date.
Michael, thank you very much. A comprehensive coverage there of all the indirect tax issues. I know that for a number of my clients, the VAT grouping has always been a concern, so I think there's some welcome changes that are coming there. But as always with you guys in the indirect tax world, I'm sure when the rules are announced, they'll be wholly complicated, so we'll be needing you to explain a bit more detail when that time arises. Right, so finally I'm just going to take you through some of the changes. No Chancellor's statement is complete, well certainly for the last decade it seems, no statement is complete without some announcements around the crackdown on tax evasion and tax avoidance. What is perhaps surprising often is that these measures are still generating a huge amount of revenue for the Exchequer, so HMRC is one of the areas for HMRC that actually easily pays for itself, so investment in the collection of these back duty taxes far outweighs the cost of employing agents to deal with that. So I think you'll see here really it is a sign that HMRC are constantly turning the screw on these matters, and these updates are no exception. I'm not going to go into an awful lot of detail on the slides. You'll see the points there, that they're quite thorough, but I think the main point to get across here is that HMRC is seeing a benefit from other measures which will increase the transparency, as it's going to start receiving data from overseas tax authorities detailing UK taxpayers' offshore accounts and interest arising thereon. This is coupled with a new register of people with significant control and HMRC's extensive data analysis capabilities, which will be able to identify taxpayers who are yet to fully disclose offshore interests which are taxable in the UK. We know that volunteering to rectify an issue before HMRC investigates will often keep down the level of penalties charged, but I think what HMRC is seeing here is they're not going to offer any more incentives for people to do this. They've got enough data and enough capability now where they will find the answers without you going and telling them about it. So they are prepared to use both civil and criminal investigation powers to complete this. So whilst HMRC is encouraging taxpayers to register and correct their tax position, individuals and corporates still need to make sure they're taking some bespoke advice, because these offerings may still not be the appropriate facility to use. Excuse me. Coupled with those changes, HMRC has also announced an obligation for taxpayers to review their tax position in the UK regarding any offshore income, assets or profits, and ensure that these have been correctly disclosed on their UK tax returns and the correct amount of tax paid, of course. The obligation exists regardless of the reason why the tax return was incorrect and regardless of why any tax returns were submitted in the first place. You'll see that there are some pretty significant penalties at stake here. It's up to 300% of the undisclosed tax, and HMRC are now saying that they will make sure that all taxpayer details are published on a government's website at some place. So it is a real name and shame environment. So again, act early is the encouragement. The date of September 18 seems a way away, but actually, in real terms, it's just around the corner, particularly given that a lot of these arrangements are complex and a lot of the structures and account holding for offshore accounts are complicated, to say the least. So that's it in terms of our detailed coverage. I hope you got something out of that. We still have a little bit of time left on our hands, so we will run through some questions. I know the questions have been coming in thick and fast, so thank you very much for participating. And I can't promise to answer them all now, of course, but we will address each and every one at some point after this webinar finishes. But I would like the panelists to perhaps cover a question or two each. So perhaps what I could do is hand back to the individuals, and maybe they could let us know what that question is and give us the answer, and then we'll wrap up from there. Howard, perhaps I can ask you first.
Yes, certainly. So thanks, Jonathan. So I've had a number of questions concerning the way that the corporate interest restriction rules will apply. and to kind of summarise the sort of the issues and themes coming out of it, whether they will apply to all types of companies and entities trading in the UK. So I think in short, yes, they will apply to, excuse me, to any entity that, whether that's domestic or overseas, that is subject to UK corporation tax on the profits that it earns in the UK. I would say that wasn't included in my slide, but there is going to be, we think, a £2 million de minimis limit. So if your interest cost is less than £2 million, you won't have to go any further. You can still take a full corporation tax deduction for the interest cost. It's only if you're in excess of that de minimis that you then have to consider the rules further. I would say that at the moment we're slightly in the dark. We're almost completely in the dark because although we have Action Point 4, and although we have the documents that the HMRC have released in the 2 consultations, we don't have any draft legislation at this time. So particularly in the way that the group override will work, or in relation to whether you can carry forward any excess limitation, or if you have a restriction, what happens to that? We don't really know how that's going to work at the moment. So the 5th of December, the day we have the finance bill, will be a very important date for us in terms of examining these new rules, exactly how they're going to work and exactly how they will impact companies going forward.
Thank you very much, Howard. So another late night of coming ahead on the 5th of December, I see, as well. Ross, perhaps I could ask you now to deal with the question.
Sure. So I've had a question here, just asking to elaborate on the changes to the foreign pension. So as I said, we didn't see much mainstream changes, if you like, around pensions, but there were a few anti-avoidance measures. So concentrated on the foreign pension. So as most people will remember, a couple of years ago, the Pensions Freedom Act came in, and that gave individuals the opportunity to take 100% drawdown of their pensions all in 1 year. At the same time, what was looked at as the rules for individuals that had gone non-resident at the time of taking that drawdown. So if you've got somebody who's moved overseas, takes that drawdown, depending on the actual tax treaty with the UK of the country they go to, they may pay local tax in that country and not tax in the UK on their 100% drawdown. And of course, potentially, depending on where they are, those taxes could be a lot lower or potentially nil than they are in the UK. So there were some rules brought in to say if that individual then returned to the UK within 5 years, they would be subject to UK tax on return. But that limit has now been increased to 10 years. So it's something to think about for those individuals retiring overseas, that they may have to think about tax implications if, for whatever reason, they decide to come back. But there are also a couple of other announcements on the pensions. There's plans to bring in line the taxation of foreign pensions with the taxation of UK pensions, and also they're also going to be tightening up the criteria for qualifying registered overseas pensions. So core ops, they're going to be looking at those and tightening up the regulations around those.
Well, thank you very much. Very clear. So as you say, the government can't seem to help generally meddle with pensions. We got let off really this time round, but as I say, some changes still needed to be made to make it complete. Thank you very much for that. Michael, could I just ask you to maybe cover something on indirect tax?
That's right, yeah. We've had a question. Someone asked about the new changes to the flat rate scheme, about the new percentage scheme, and whether it was possible to sort of buy a car or something so that you would come above the 2% threshold, so that you didn't have to apply the new percentage. I think it's one of the things that HMRC have already thought about, and when you look at goods purchased, they are specifically saying that excludes capital assets or any motor cars that's purchased by the business. So, obviously, that's something HMRC have already thought about. So those excluded have to be goods which you buy other goods for use in the business or for resale.
Thank you, Michael. Yeah, these days it's difficult for HMRC not to have covered off the question before you ask. Yeah, I'm afraid, isn't it? It seems to be the case. I'm not going to answer any of the questions around the new disclosure rules or the tax evasion. Unlike HMRC, BDO don't like to publish their clients' questions and answers, so we're going to be keeping that. If there are any, we will follow up on those after the webinar itself. So I think that probably draws us to a conclusion. just to say thanks to everybody for joining us and patiently listening as we run through the autumn statement review. I really hope you found it informative and of value, and that it helps you steer your way through the complexities that are constantly thrown at us through changes in the tax legislation. We will be asking you to complete a feedback survey, so if you have a chance, please could you do that and return it to us. Just helps us to work out how we can improve these things going forward. We'll also be, as I say, circulating both a recording and a link to the website pages where you'll find our full report. If you're still short on some detail, then go along to bdo.co.uk, and it's even I can find my way through to the budget pages, so that should be fairly straightforward for the rest of you, I hope. Any other questions? As I say, if you've raised a question, don't be concerned. We will answer those, and we'll get through those as soon as we possibly can. So just as I say, one final thing. Thanks to the panel for joining me today here, and thanks to everyone there for listening. We've now drawn this to a conclusion. Thank you.